Hi, and welcome to another presentation. We're going to start today by looking at the front page of Yahoo Finance. This is one of the best places for to go for news about the stock market. Um, you can see the biggest story today in the news is we're having earnings reports coming out, and every day we have different indications of what stocks are going to be going up and down. You can see that one of the biggest things happening this week is a lot of the stocks revolving around the AI infrastructure trade are going up and down lots. So we have memory makers coming out with their earnings this week. We have HK Hynix, they're the largest memory maker in the world. They came out with their earnings. We have a lot of uh, pressure from overseas recently. We had the Korea stock market going down a lot, and along with it, all of the memory makers in Korea, like Samsung and Hynix, SK Hynix. So, and in America, we have a lot of short selling, meaning um, a lot of companies are being sold short, and that's making the price go down a lot for a lot of the tech companies we're following. You can see that just this stock right here, SKHY, SK Hynix, they're down 9%, and there's more selling overseas for that stock. So um, I guess that's we're going to look at some of those stocks, and in particular Nvidia and Broadcom. But let's look at the S&P 500 like we usually do. You can see that we're in a trading range right now between 725 and 759. So we're kind of stuck here, but you can see that we're oversold in the stochastics. This is 22. This is as low as it gets. So there's a good potential of a bounce in the stock market whenever you have an oversold condition. And we have this week we have earnings coming out. So we have, let me see, we have Microsoft, Meta, MasterCard, Amazon, Apple, Altria. So we have a lot of the big companies that we're following coming out with earnings, and that's going to make stocks go up and down lots. So a lot of times this is a good time to buy stocks whenever stocks sell off after an earnings report. Like last week, we had an excellent earnings report from Google, Alphabet, and their stock went down 7%. Um, but the great thing about companies that we're following is great stocks recover. So there's different reasons for stocks to go up and down. Sometimes there's players that are um, market participants that are trying to play the market and trying to make the stocks go down so they can buy it lower. So we have to kind of look beyond the up and down of the market every day and look at the fair value. And we'll do that. We'll do that today. Let's look at some of the let's look at the S&P 500. And you can see when we draw the trend lines in, we're at the bottom of our trading range in the S&P, and we're oversold. So this is one of the, it doesn't get any better than that. And you have a well-defined uptrend. So right now we have earnings coming out, a lot of earnings at the beginning of earnings season. So that's a good catalyst for stocks to go up. However, we are in one of the most volatile times of the year. So if you can see, let's look at our volatility chart. We're going into August. This is actually going to be August next week. So look at this: August, September, October. October is the peak of volatility. So you got to be ready for a lot of ups and downs in the market. And look at this: August, September haven't been that great return seasonality wise. So you got to mentally prepare yourself for a down August and a down September. But traditionally, you see it towards the end of the year. We usually have rallies, so you got to be ready for that too. Okay, let's look at some of our numbers. Um, we do have a Fed meeting coming up on Wednesday. We're going to have the Fed decide whether they want to raise or lower interest rates. There are some say that we could raise, and there are some that say we could reduce the interest rates. So that could make a lot of market volatility. But just keep in mind the fair value of the stocks that you're buying and um, try to keep your eyes on the price. What else is happening here? Okay, so let's look at the earnings from this past week. We had GE Vernova, AI infrastructure play. We have Tesla. They reported and their stock gapped down 14%. Tesla is one of the most overvalued stocks in the stock market. And right now, their sister company, SpaceX, isn't doing too good. They went down a lot. So both companies are kind of um, their stocks are going down. Alphabet had a really great quarter, but their stock went down 7%. So it's starting to recover now. It's almost recovered half of those losses. IBM, they had pre-announcement 2 weeks ago, and it went down 25%. So now they've released earnings, and there was nothing new in that earnings release, and it went up a little bit. And CSX, they are the railroad company. Um, the president of CSX said, "We're not making any new railroads," and that is the truth. So they have a monopoly, and they're charging more for their freight, and the company's doing really good. Intel reported their earnings. They went down since the earnings report. Verizon and American Express reported. American Express went down. I like to look at, I like to keep track of Warren Buffett stocks. This is one of his top five holdings, American Express, and it most recently went down. So what Warren Buffett likes about American Express, the return on equity is 30. And Warren Buffett refers to that 30 number as they keep growing and they're um, they're a compounding growth company. So whenever a stock like that sells off, let's look at American Express just for fun. I got the wrong company name. AXP? AXP. Okay, that's better. Okay, so you can see we're in a well-defined trading range. This being the top 361, this being the bottom 299. But we can see we're oversold. We had a big sell-off here. And I like to keep track of these, and I like to buy them right around here, around $300 a share. Let's look at the big picture. You can see Warren Buffett bought this in the 60s, so he's doing really good from his initial purchase price. But you can see this, we're like a little uptrend right there. So another good thing about American Express, right now the financials are out of favor. We can see from let's look at our valuations chart. There it is right there. This is S&P sector PE valuations relative to history. And you can see financials is one of the most undervalued sectors. And so whenever there's an undervalued sector like energy, financial, materials, um, healthcare, I like to look at stocks in that sector to buy and hold. And this American Express is what I'm looking at and is an example of a buy and hold And Warren Buffett advocates buying it. So, and it's in the fintech space. So payment space is very profitable. So we'll keep our eye on that one. It is, let me see. Okay, so it's oversold. You can see that. And I guess right here, 300 is when I would want to buy it, or right here, which is three. Yeah, right there, because it has a lot of support and it's like in a trading range too. So let's watch that. Okay, so let's go back to our, okay, hold on for a second. All right. Okay, so the S&P short range oscillator is 0.33. Um, that means we're oversold. And the stochastics, this is what I trust the most. You can see that's down really far. So we're oversold, and the translation here is the market is oversold, suggesting a potential rebound. Okay, so we got to get ready for that. Right now, this week, the price of oil has been decreasing. So our translation is inflation decreases, interest rates decrease, chance of rates go up, rate cuts go up, stock markets like rate hikes. And so, but that all changes whenever the Fed meets. And if they say the interest rates are going to go up, then the stock markets usually go down whenever that happens. So let's see what happens on Wednesday. Okay, so let me see. Okay, you can see that in the last week, the Treasury has a yield has been going down, and the stock market has been kind of sideways. But usually, whenever the 10-year Treasury yield goes down, that's good for the stock market. It's an inverse correlation usually. So let's look at the major variables in the market. You can see that the price of oil is down 1%. Um, well, the inflation hasn't changed. The dollar is up 1%. And a stronger US dollar tends to drive gold prices lower. And that's exactly what happened with gold. It's down 2.5% this week. Okay, so let me see. The US dollar is kind of in the trading range. It's been going up a little bit recently. Fear greed index. We are more fearful than last week. So we are into fear. Our translation is start looking for things to buy. So this week we're going to be looking at some undervalued growth stocks. And this is one of the first time all of our contrary indicators are the same. So we have a bearish individual investor in our translation. It's time to start looking for things to buy. So the individual amateur investor have been bearish for quite a while. So that is everything is leaning towards it's time to buy something. Okay, so the VIX is also it's at 18. So it's not very high, but we have complacency in the market. So it's like a trading range. So people aren't super fearful yet. Um, okay, so our emotional graph, yeah, we have fear in the market. And one of the biggest fears in the market right now is that some of the bigger stocks are borrowing money for AI, and that might not pay off. So, and the stocks that are more conservative are the ones being rewarded now. Like Apple hasn't spent a lot on AI, and it's being rewarded because they're benefiting from AI because other companies do the research for them, and they're not involved with that whole process, and they can keep their money. So let's look at okay, let's look at the PE valuations relative to history. You can see the industrials are the most overvalued compared to history. And IT is kind of 50-50. So it's almost a good deal. So IT is a sector I would be looking at. Energy, financials, and communication services and utilities, healthcare are basically lower compared to history. So whenever I'm doing my screens, I want to look for energy stocks, healthcare stocks, IT stocks, because compared to the 10-year history here, you can see that their stocks are kind of lower relative to history. And the sectors doing the best so far this year: energy, industrials, real estate, IT, materials. The ones doing the worst are consumer discretionary, communication, and financials, healthcare. Okay, so that was, and if we look at our first to worst, once the sectors doing the best from last year, XLC, is one of the worst this year. Look at that. It's -2%. So the ones doing the worst last year, real estate, consumer staples, and energy, are some of the best performers this year. So that's um, that's just a good example of why you should be diversified and why you should think contrarian in your investing, because you never know when a sector will go up or so. Let's look at Okay, let's look at some of the stocks going up and down the most. Market movers. Okay, today was okay. So let's look at some of the stocks that went up and down the most today. We see a lot of the memory makers. They're very volatile. Some of the AI infrastructure plays down a lot. A lot of this was due to short selling. So let's look at some of our talking points here. Hold on. Okay. So the big story this week for what we're watching is the memory stock sell-off created a strong entry point. That was from last week. And we were keeping our eyes on these stocks. The sell-off in semis is largely driven by short selling heading into hyperscaler prints this week per UBS. And our PB data over the last two sessions show high frequency HFs beginning to put on tactical shorts in U.S. semis ahead of hyperscaler capex estimates due tomorrow. That's a notable shift from earlier momentum unwinds to selling that was almost entirely driven by longs getting cut. This is new shorting behavior in semis. Okay, so the thing to keep in mind here, sometimes stocks go up and down lots. And the reason for that might be technical oriented, not fundamental oriented. We like to keep in mind what the fair value of a price is and try to dollar cost in the positions. Um, so, so Google reported their earnings. They were stellar, really great, but their stock went down. So maybe now the interesting thing about this short selling heading into this hyperscale print is if we have good earnings, like we did out of Seagate recently, then the stocks will gap up because of short covering. So you could have a lot of movements plus 10%, minus 10% this week as earnings come in. Just keep that in mind. Okay. So now let's look at right now this week. Okay, let's look at some more of the stocks going up and down. We have we have Sherwin-Williams. They make paint. Um, and as interest rates went down this week, that helps the home builders. So the home builders, this is a direct one-to-one correlation to how the home market is doing because there's a lot of painting going on in the homes these days. We have um, Charles Rivers Laboratories, that's healthcare. We have Cognizant, that's technology consulting. Accenture, which is technology consulting. Okay. So we have some software companies here and that went down lots at the beginning of the year. We have Workday, they make software for businesses. We have consulting companies, and we have FactSet, which is another company that was thrown away with the software stocks. We have a lot of software companies going up today. So the ones in NASDAQ going up, it's basically the same. A lot of the AI chip trades. And what can we see from this? We see, okay, we see some health companies doing good. United Healthcare, we see a lot of home related companies. So as the interest rates go down, companies that benefit from home building and home renovation will do good. So that's 3M. We have Sherman-Williams and Home Depot. Okay, that was good exercise. Let's go back to our talk. So this week, the yields of the 10-year have been going down. So that's positive for technology, small caps, um, companies that are yielding a lot, so such as utilities. Let's see if that's what happened in the sectors. We have the sectors going up and down the most. Home construction, that is definitely a one-to-one correlation. Interest rates go down, home construction goes up. Same thing with healthcare, high dividend sector, and there we had a risk off market today. So if we see our risk on, risk off cheat sheet, um, this today we had stocks that are energy, consumer staples, utilities, healthcare, defensive companies doing better, and the risk on companies doing bad. So at any point in time, any day, we're going to have a risk on or a risk off. There's usually not one or the other. So, but right now, I expect the risk on for at least the next week because we're oversold right now. So keep your eyes on the more aggressive stocks and sectors to do well in the next week or so as earnings come out. Okay, that was good exercise. Okay, I picked out some charts that were interesting. You can see that we're in a well-defined downtrend for the QQQ technology-related stocks. So you can see that um, we're making a jagged line lower, like we're stepping down in this chart, moving towards a 100-day and 200-day moving average. So whenever I see a rally in the stock market, I look at these marks, and as soon as it gets up to the top part of that rally, I know we have a decision to make to go back down to here, to here, to here. Um, so keep an eye on the big picture. The big picture is we're still in an uptrend um, as we have positive momentum in all the moving average in most of the moving averages. Um, but keep in mind this downtrend, and let's look at the XLV. This is like quite the opposite chart. This is a healthcare sector, and you can see it's been in an uptrend since for at least a year. Um, and this is one of the most undervalued sectors in our sector list. So you can see we're oversold. And this is, so in other words, if you buy a stock in this sector, there's a good chance that the bias is towards going up versus going down because the whole sector is in an uptrend. But you can see that Um, let's look at Altria. This is a high yielding um, stock. They yield around 6 or 7%, but you can see we're in an uptrend with that stock, and it's in higher demand today because interest rates are starting to go down. And depending on what happens during the Fed meeting on Wednesday, um, high yielding stocks might do better or worse. So if their interest rates go down during the meeting, then there's a higher demand for high yielding stocks. But if there's risk on and the tech stocks start going up, stocks like that pay a dividend that are conservative like this will go down. Let's look at AT&T. You can see that it's been in a downtrend for quite a while, but it broke out of that downtrend about a week or two ago. So you can see we're starting this new uptrend. Um, we're just a little bit overbought with AT&T right now, but for a stock that you can buy and hold for a dividend, um, it's in a pretty um, established range. It's a lot of these telecom stocks they sold off because SpaceX possibly might be getting into being a provider because they bought some bandwidth from Dish Networks, I think. So let's see if this continues to be a high yielding company that's kind of safe. Okay, Meta, you can see the stock is in a downtrend. And any rally that they've had recently has been met with selling. And that's due to most likely them spending a lot of money on AI infrastructure build out. And whether or not they're going to get payback for that spending is unknown. So that's why a lot of these hyperscalers are going down. Let's look at NVIDIA. This is one of the most interesting charts that I can see. They're an undervalued company and stuck in a trading range. So you can see that the low to the trading range is right around here and high. We're kind of in the middle of the trading range right now. But it seems like um, they're undervalued and you have a margin of safety. It seems like a good stock you can trade um, or hold on to for long term. They're above all their moving averages and they have earnings coming out in a month or so. So let's keep an eye on that. Some of the stocks that showed up on our screen, they were kind of interesting. Netflix has traditionally been a very expensive stock with a PEG ratio over 1, and it's approaching a PEG ratio of 1, which is interesting. Um, we went over them 2 weeks ago, and they're compared to their growth rate, they're still a little bit overvalued. So I'd wait for that to go down lots. Look at this. Oracle is a PEG ratio of 0.78. The one issue with Oracle is they're spending lots on their AI infrastructure, and their credit default swaps are very expensive. So that means people are worried that they are investing in an AI data infrastructure and might not get their payout from that investment. So anything involving debt, Warren Buffett doesn't like that. It's just a slower, it slows your growth and it makes your stock more risky. Some bank stocks are undervalued according to this, Citigroup and Schwab. So we have a lot of banks in the top 10 here, JP Morgan, Bank of America, so HSBC. So we have a lot of banks that screen really well as growing good and are consistent stocks that will pass all the screens for this screener. So we'll keep an eye on those. All right, so we already talked about this. The memory stock sell-off created a strong entry point, and every day we're going to have stocks like this go up and down a lot. Um, So we just have to keep an eye on the fair value of the stocks. Let's look at Warren Buffett's investing rules. He likes gross profit margin of 40% or higher. Let's look at the let's look at the fundamentals of a stock while we're looking at Warren Buffett's rules. I thought that'd be interesting. We'll look at NVDA. We'll look at NVIDIA because we're going to look at NVIDIA a little bit later. Okay, so Warren Buffett's rules. Let's look at them. Gross profit margin, 40% or higher. Okay, profit margin, 60% for NVIDIA. So that matches. Return on equity of 15% or higher. Return on equity, 114%. That's 10 times what we're looking for. Persistent growth, growing earnings per share, EPS. Let's look, um, let's look at NVIDIA's NVDA. Persistent growing earnings per share, EPS. So we'll look at their EPS. Okay, we'll look at it later, but they're growing, definitely growing persistently. Low debt to equity ratio. Let's look at NVIDIA's debt to equity ratio. Total debt, total cash, 53 billion, total debt, 12 billion. So they have more cash than debt. So they don't, that passes the low debt to equity ratio. Adequate cash flow. Let's look at that. Levered free cash flow, 46 billion. Yep, that passes. Strong balance sheet. We just looked at that. History of dividend payments. They pay 0.1%, which isn't that great. Um, Management team has honest and competent. A business that, no, he would not buy NVIDIA because Warren Buffett would not understand AI. Business cycle that is not cyclical. Hmm. NVIDIA and the chips industry is cyclical. So Warren Buffett wouldn't like this company because it is cyclical means it goes up and down with the economy and it's not a consistent earning company. Business that has a moat. They definitely have a moat. NVIDIA has a moat. Businesses that are undervalued. Let's look at their PEG ratio, 0.54. They're at least half priced according to Yahoo Finance. Businesses that are comfortable owning for the long term. It's very hard to invest in a company like NVIDIA, knowing this is why Warren Buffett wouldn't invest in a lot of these tech companies because things change so fast. How you know in 10 or 20 years if a company is going to be still doing good? Because the company like Intel was the best semiconductor company and the largest 20 years ago, but today NVIDIA is the largest. So it's very difficult. So that's another reason why Warren Buffett wouldn't like this company. Don't afraid to be to walk away from a deal. Okay, that's great. We'll go over Warren Buffett's investing rules every now and then just to compare it against some stocks we're looking for. This is a very interesting note from Roy Maddox. He said that right now the PEG ratio for the S&P 500 is, and we're oversold more than any time this year, and it's time for an oversold bounce. Um, Another thing to keep in mind is from this guy, S&P now is at the lowest peg ratio in 30 years. So the peg ratio for the S&P 500 right now is 0.8. So it is 20% undervalued compared to their growth rate. Um, what's been happening this year is the earnings estimates for the S&P 500 has gone up 25%, and the stock market hasn't gone up that much. So we have basically an undervalued stock market right now. Um, so right now we have a lot of people with all of their cash spent on stocks. So that means there's no cash on the sidelines to buy stocks if the stocks go down. So keep that in mind. And there's an article here, 5 stocks to buy when they're reasonably priced. So we have NVIDIA, Broadcom, LPLA Financial, LPL Financial, T-Mobile, and CNH. These are all different industries. We have NVIDIA and Broadcom. They are chip companies for the AI infrastructure. We have LP Financial. They're the largest provider of financial services for the brokerage industry. And we have T-Mobile, of course, they're a phone company, and CNH. They are an industrial company that helps build things. Okay, so let's look at each one of those just for kicks. We have NVIDIA. It's been a stock we follow regularly. It's the largest, one of the largest companies in the world. I mean, they're number two compared to Apple right now. They're four-star rated stock. They say Morningstar says they're at 26% discount to fair value. Um, there's very high uncertainty in the company. They noted that if you look at the chart, the stock's been in a range between 190 and 230 per share. Let's look at that. You can see that's one of the reasons why they like this stock. It's kind of range bound and it's kind of a safer um, company that's not as volatile. You see, but when you look at NVIDIA's long-term investor and think about artificial intelligence, a forward PE in the stock is 22 times. Their 5-year compounded annual growth rate is 35%. So that gives you a PEG ratio of 0.6. So they say they're 40% undervalued. I did the numbers just to double check on that. You can see they're growing at 41% from this year to next year. Does that match what they said? 35%. Yeah, it's close. And their forward PE is 22. So the PEG ratio is, that means they're half priced. So you can see that all their numbers are really good. We just went over that. Profit margin 62%, return on equity 114, and they're positive free cash. They have more cash than debt. So this is I'd say one of the safer companies in the tech sector. They're trading in a range, they're undervalued, and they're growing at 40%, which is pretty amazing. Um, okay, so let's look at the next one. This is Broadcom, AVGO. This is they sell chips very similar to a competitor for NVIDIA. They say they're a 40% discount, and the uncertainty is very high. They said, here's how they qualify as a GARP stock. They make XPUs, they're custom AI accelerators, and it looks pretty cheap, they say. They've done a pretty high forward PE ratio based on our expectations. They are looking at 33 multiple, but our 5-year compounding rate is 46%. So they say they're 30% undervalued. Let's look at see if that matches our numbers. From this year to next year, they're going at 68%. After that, 33%. So their forward PE is 20. So that means if you divide 68 by 20, that's almost 0.3 something. So their PEG ratio is 0.29, which is 3 times undervalued. So you can see they're in a very similar trading range as NVIDIA. They're above all of their moving averages. They have momentum, and you can see that they're hugging the moving average, which is the 100-day moving average, which is very positive. So if we have a sell-off in the chip sector, they usually go down to their 200-day moving average, which is right there. So this is a really good stock to look at. The next stock they have on their list is LPL Financial. Okay, it's not a tech stock. So this is another example of a stock in a sector that's undervalued right now. This financial sector, a lot of those stocks are out of favor. They are the largest independent broker dealer. So we think there are a couple of different ways they benefit over time. They want to increase their assets under management, and that increases their annual money they make. And so if you're looking at a forward PE of 13 times, divide that by 20, and the PEG ratio is 0.7. So let's look at those numbers as we look at them. Um, Growth from this year to next year is 26%. The forward PE is 13. So that confirms that they're half priced. So let's look at their stock chart. You can see that they're in a downtrend. And right now we're at the top end of a downtrend. Let's see if that company breaks out of that downtrend. Otherwise, the chart just says they're going to go down to here next. They're overbought right now, so it's definitely not a good time to dollar cost into this one. The other stock they have here is an undervalued stock is T-Mobile, TMUS. A lot of the mobile stocks, um, the telephone stocks, went down a lot this week because there's a new entry into the phone service market, SpaceX. So in the SpaceX IPO listing, they said they're going to be involved with telecom. So this could be a time to look at some of these sectors, these companies like AT&T, Verizon. Um, but T-Mobile seems to be undervalued. They're a GARP stock. Let's look at their fundamentals. From this year to next year, they're growing at 26%. Their P ratio is 16, so their PEG ratio is 0.57. That means they're half priced. Um, their numbers are really good. Up profit margin 11, return on equity 17. So that matches Warren Buffett, what he's looking for. Oh, here's one big problem here. They have 120 billion in debt, so they have a lot of debt to pay. So they're going to be at the mercy of the debt market for until they pay all that off. They bought Sprint, and that was a really big purchase. So until this debt level goes down, they're going to be very volatile, and um, people don't pay as much for stocks whenever they have high debt levels. So we'll keep our eyes on that total debt number and see if that goes down over time. T-Mobile, you can see they're an established downtrend. Like pretty, this is like one of the worst stock charts in the market right now. So when it breaks out of that, that's the time to start looking at this stock. Otherwise, it's going to keep going down, it seems. Let's look at CNH. They are an industrial company. The company's revenue, 80% is ag equipment. Other 20% comes from construction. So that's a good diversification away from some of the stocks we're looking at. They think they're at a 46% discount. So the forward PE in the stock is 22 times, which is the kind of growth they're looking for. 5-year compounding annual growth rate of 32%. They think they're 30% undervalued. Let's look at their chart. You can see their sideways chart right now. They, of course, will benefit from the big, beautiful bill, which will increase spending. We have AI infrastructure build out they could benefit from. Let's look at their growth rate. From this year to next year, 70%. That is pretty good. And their PE is 25. So they're at least half price to one-third the price they should be. But let's look at this profit margin. It's not good. Warren Buffett wouldn't approve of these numbers. return on equity is 4. We're looking for at least 15. Profit margin, we're looking for at least 10. That doesn't match. So we're going to hold off on that one for now. All right. Well, I hope you enjoyed the talk and I hope you have a good investing week. Remember, this is undervalued stock market right now. There's going to be a lot of volatility in earnings announcement season, so keep your eye on the fair value and hope you have a good week ahead. Talk to you later. Bye.